Here's something that catches many retirees off guard. Having $2.5 million in a 401k can actually create a tax problem in retirement. It sounds like a strong financial position, and it is. But without a strategy, you could end up paying hundreds of thousands and more in taxes than you need to. Let's talk about why that happens and what you can do about it. Hi, I'm Mark Aarons, president of Money Managers Inc. And if you want to explore how this applies to your own situation, there's a link below where you can book a conversation with me. Today, I want to walk through a scenario that's more common than you might think: retiring with a large balance in a pre-tax retirement account. If you're sitting on a $2 million, $3 million, or more in your 401k or traditional IRA, you've done a great job saving. But the tax bill that comes with those distributions can be significant, especially once required minimum distributions kick in. This applies whether you built that balance through decades of consistent contributions, company matches, strong market returns, or a combination of all three. The accumulation phase rewarded you with tax deductions. The distributions phase is where the IRS gets paid back, and the bill can be larger than many people expect. If this is irrelevant to your situation, go ahead and hit the like button and subscribe for more retirement guidance. Let's get into it. The tax reality of pre-tax retirement accounts. When you contribute to a 401k or traditional IRA, you get a tax deduction up front. That's the benefit. But the trade-off is that every dollar you take out in retirement is taxed as ordinary income. If you have $2.5 million in a 401k, that means the IRS has a claim on a portion of that balance, depending on your tax bracket. That could be 20, 30, or more percent. So the next amount you actually control is lowering the account value suggests. That's an important distinction when planning your retirement income. Let me put that in perspective. If you're married filing jointly and your taxable income falls in the 24% federal bracket, a $100,000 distribution could result in $24,000 going to the federal taxes. At state taxes, say 5%, and you're looking at $29,000 total. Your net, $71,000. Now imagine that happening year after year. The cumulative tax cost over a 20 or 30-year retirement can be substantial. The challenge is that most people don't think about taxes while accumulating. They focus on the account balance. They can celebrate when it crosses the $1 million mark, then the $2 million mark. But in retirement, what matters is how much you keep after taxes, not what the statement shows. Required minimum distributions changes the game. Now, at age 73, the IRS requires you to start taking minimum distributions from your pre-taxed accounts. These are called RMDs, required minimum distributions. The amount you're required to withdraw is based on your account balance on your life expectancy. And as your balance grows, so does the required distribution. Now, here's an example. If you have $2.5 million in a 401k at age 73, your first RMD could be around $94,000. That's taxable income whether you need it or not. Add that to Social Security, a pension, or other income, and you could easily find yourself in the 24% or 32% federal tax bracket, or higher, depending on your state. And here's what many people don't realize. RMDs keep increasing over time. As you get older, the IRS divisor gets smaller, which means that percentage you require to withdraw goes up. By age 80, you might be required to take out over $130,000 from the same account, assuming modest growth. That can walk you into higher tax rates for decades, even if your spending needs don't require that much income. And if both spouses have large 401k balances, the problem compounds. Two accounts mean two sets of RMDs, which can push combined taxable income even higher. I've seen couples with $4 million or $5 million in combined pre-tax accounts facing annual RMDs well over $150,000. At that point, you're firmly in the higher brackets with limited flexibility to reduce taxes. The impact on Social Security and Medicare. Here where it gets more complicated. When your taxable income rises, it can trigger taxes on your Social Security benefit. Up to 85% of Social Security can become taxable, depending on your income level. The threshold for this are surprisingly low. For a married couple, if your combined income, which includes half of your Social Security plus other income, exceeds $44,000, up to 85% of your benefits become taxable. With $94,000 in RMD, you're well over that threshold. So not only are you paying taxes on the distributions itself, but you're also paying taxes on Social Security income that might have otherwise been tax-free. Then there's Medicare. Once your modified adjusted gross income crosses a certain threshold, you'll pay IRMAA surcharges, income related monthly adjustment amounts. That means higher premiums for Medicare Part B and Part D. For 2025, those surcharges started at $212,000 for married couples filing jointly. If your RMD purchases you over that line, you could be paying an additional $200 to $400 per month per person in Medicare premiums. So it's not just federal and state income taxes you're dealing with. Large RMDs can create a ripple effect across your entire retirement picture, affecting Social Security taxation, Medicare costs, and even your ability to qualify for certain deductions or credits. Strategies to reduce lifetime taxes. The good news is there are strategies that may help reduce this tax pressure, but they work best when implemented before RMDs begin. One option is Roth conversions. This involves moving money from your traditional 401k or your IRA into a Roth IRA. You'll pay taxes on the conversion in the year you do it, but future withdrawals from the Roth are tax-free. And Roth IRAs are not subject to RMDs during your lifetime. If you're in your 50s or 60s and still working, or recently retired in a lower tax bracket, converting portions of your account over several years could help reduce your RMD burden later. Let's say you're 65, recently retired, and in the 22% tax bracket. You might convert $100,000 per year from your traditional IRA to a Roth. You'll pay $22,000 in federal taxes on that conversion. But if you're waiting until age 73, you mean bringing in to 32% due to the RMDs, you'll potentially save 10% points on the money. Do that for 5 years. You'll move $500,000 into a tax-free account, money that will never be subject to RMDs and can grow without future tax liability. The math on this depends on your specific circumstances, but the principle is straightforward. Paying taxes at a lower rate now may make sense if it helps you avoid higher rates later. Another approach is strategic withdrawals. Instead of waiting until 73, you might start taking distributions early, especially in years when your income is lower. This can help reduce the balance subject to RMDs and spread out the tax liability over time. This is particularly useful in gap years between retirement when you claim Social Security. If you retire at 62 but wait until 70 to claim Social Security, you have an 8-year window where your taxable income may be lower. Using that time to draw down your 401k strategically can help manage your long-term tax situation. You can also coordinate withdrawals with charitable giving strategies. If you're charitable inclined, qualified charitable distributions, or QCDs, allow you to send money directly from your IRA to charities once you reach age 70 and a half. These distributions count toward your RMD but aren't included in your taxable income. You can donate up to $111,000 per year through QCDs. For someone with a $2.5 million 401k who plans to give to charity anyway, this can be a powerful way to satisfy RMD requirements while reducing taxable income. Another consideration, if you're still working past age 73 and participating in your current employer's 401k, you may be able to delay RMDs on that specific account. That doesn't apply to IRAs or old 401ks, but it can provide some relief if you're in that situation. Why timing and planning matter. The key is the tax planning in retirement isn't a one-time decision. It's an ongoing strategy that should be reviewed regularly based on changes in tax law, your income needs, and your account balances. Waiting until RMDs start can limit your options, but if you build a plan that considers your full financial picture, when to take Social Security, how to structure withdrawals, and how to manage taxable income, you could potentially save tens or even hundreds of thousands of dollars in taxes over your lifetime. That's the difference between reacting to tax obligations and planning around them. And here's something else to consider. Tax rates. The tax cuts that went into effect in 2018 have been made permanent by the One Big Beautiful Bill Act, passed in July of 2025. The current tax brackets will continue until the future. This removes a major source of uncertainty for retirement planning. You can now model your tax situation with more confidence, knowing these rates won't suddenly jump. However, Roth conversions may still make sense if you're currently in a lower bracket than you expect to be during your RMD years. This is why personalized planning matters. What works for one person may not work for another. Your income sources, spending needs, legacy goals, and tax situations are all unique. A strategy that makes sense for someone with 2.5 million in their 401k and no other assets looks very different from someone with the same 401k balance, but also $1 million in taxable accounts and a pension. The goal isn't to eliminate taxes. That's not realistic. The goal is to structure your retirement income in a way that minimizes unnecessary tax costs while supporting the lifestyles you want. So to recap, having a $2.5 million in 401k is a strong foundation for retirement, but it comes with tax complexity that shouldn't be ignored. RMDs, Social Security taxation, and Medicare surcharges can all add up quickly. The earlier you start building a tax strategy, the more control you have over your retirement income and more you keep working for your instead of going to taxes. These decisions are often more impactful than portfolio returns when it comes to your net retirement income. Getting them right requires looking at your complete picture and planning several years ahead. If you're approaching retirement and want to make sure your plan supports your goals, you can schedule a conversation using the link below. Thanks for watching, and I'll see you in the next video.